Welcome back to the Hub channel. My name is Brandon, and we have another amazing show for you today. A couple weeks ago, we got together, we went over a trade. It was a Generac trade, and I think Jeff's going to go over that here in just a second on how that trade did. But we have a really good trade coming up towards the end of the show that I think you're going to want to stick around for because it is entering into a sector that I think everybody's talking about. So you're going to love that. We're going to hit on markets, we're going to hit on some top headlines, and we're going to cover it all in today's show. So let's go ahead and bring Jeff in here. If you guys don't know Jeff, obviously he is our senior strategist, our professional trader over the Ewo channel, and he knows what he's doing. He knows what he's talking about. He likes to do breakout trades that are moving in the market, straddles, strangles, butterflies, you name it. Jeff does it. Jeff, how are you doing today? How's your weekend been, and how are things looking?
Oh man, it's a great weekend. We're headed into the last week of trading for the month of February. Actually, last week was the last full week. March starts this Friday. But lots of information coming out. We're going to get to it right now. Let's start with that trade that you mentioned on Generac. You know, this is historically a pretty good mover, and it's kind of seasonal. Since we've had somewhat of a mild winter, it just kind of goes to show this stock didn't really move like it does. But spring brings tornadoes, at least in my part of the world, and then summer, and then fall, and this stock can be a mover. The good news is we made our money back, pretty much a break-even trade. So we took that capital, we're going to redeploy it today. So kind of a break-even trade on Generac, but hey, that's that. We'll take those over any big loser any day, Brandon.
Yeah, I think that's fair, but that just goes right along with your trading style, Jeff. It's nice because you set up a trade safely this way and you don't lose money on it, even though you put yourself out there to have the potential to make money. So I think a win is if you even if you break even or you make money, I think that's a win in my book as well. What are you seeing for headlines in the market right now, Jeff? What's happening?
Well, interestingly enough about headlines, it's just a very few headlines we have that speak volumes. And we'll start right off with interest rates in the Treasury. A Fed Reserve governor. Well, first of all, there's lots of economic indicators coming out this week. We'll talk about those in a moment. So you have economic indicators, and then you have a little bit of Fed speak going on. We have Christopher Waller, not Christopher Warren, the actor, Christopher Waller, speaking about more evidence required before we start cutting rates. This ties right in, Brandon, with some of the speak that we've been talking about, that higher for longer is at play. I wouldn't be surprised if we don't cut for a good part of the year. The real risk is for higher rates, and you are hearing that from more and more people right now. But that's the real risk to the market right now. I think everybody's trying to price in price cuts, but the real risk is on the other side. And then we still have earnings just flowing out. We have over 1,000 companies declaring earnings just this week, and we'll get into some of those names here in just a few minutes.
How do you think they read it so incorrectly? I mean, when they came out in December, they said they were going to cut rates here this year. And now, as we get further and further along into March, all I keep hearing is, yeah, they're not going to cut rates till maybe September now. And like you said, they could possibly raise rates. So what was that? What's with the misread, Jeff?
Well, I think it's a lot of optimism. They're still trying to digest how the consumer is surviving. Higher inflation numbers, even though they're saying inflation is under control. I'm not sure they're looking at. They've made some adjustments to how they calculate those numbers. That's not really being discussed either. But some of the, for example, on jobs, those numbers are calculated a little bit differently than they used to be. And so jobs seem steady, and there's various things that are going on in the marketplace that aren't really discussed. But, from some people saying there'd be 5 cuts this year, man, we're just not seeing it. And you'll see here in a moment, interest rates overall are back on the rise again.
Yeah, it's not going to happen. I don't think we have 5 cuts. Not even close, Jeff. What the markets? Obviously, last week we came off an Nvidia earnings, crushed the market. It was the talk of the town. Everybody, I mean, it's contributing to the S&P, the QQQ, everything else. But what are you seeing right now in the markets this week so far? I know we're early in the week. It's only Monday, but what are you seeing right now?
Well, Brandon, I think it's ironic that we've gone from the Magnificent Seven to the Stupendous Four, whatever they're calling now. We've whittled it down from 7 stocks to just 4 stocks that are really making news. I guess another headline that I didn't post was that Walmart had their first dividend split since 1999 today. I guess I could have added that as a headline. That's actually very interesting news that we'll talk about probably at another time. But looking at the Spider Index Trust here, you're looking at SPY, and look at this just beautiful, nice trend. Now, I'm just going to go from this last pivot point and just put a little regression trend channel on. And one thing that with regression trend channels is that sometimes these come with a feature called Pearson's R. It's not listed here, but it's a little indicator to tell you how well a stock is staying within the trend line or trend channel that has been drawn. And I can tell you right now, this is about a 96. It scores a 96 on Pearson's R, and that's out of 100, meaning this is a very nice, tight, controlled trend channel. And the reason why we like this is I can simply draw a little line here through the middle of price, and I can target out in the future where I think the price is going along with time. So here by the middle of March, we could be up at 520 on the Spider Index Trust. That's 520 by the middle of March. If we stay within this channel, I think it's very achievable. We go back lastly here and looking at Heiken SE, because I love using these candles because it verifies the trend. The last few candles we have are no wicks on the bottom, which means we're back. The bulls are back and we're continuing to press forward. The only curveball here to all 3 broader markets, or really 4 broader markets that we look at, Brandon, are earnings, and we'll continue to see a flood of results coming out this week.
Yeah, that's a good take, and I'm surprised the S&P is still moving up. But I mean, with Nvidia controlling the narrative here, obviously a big weight in that portfolio. I think its percentage moved up maybe 1 point in the S&P, making it at 4.5% of the S&P now, which is a big amount for Nvidia. And then you got Microsoft, Apple, and just like you said, the Stupendous Four controlling the narrative here. But 520 looks like it's in the cards for me as well. I don't think we're going to see a pullback down to that 480, even to the 460 level, like I thought originally before earnings season. So quite the shift here. What else is going on in the market right now?
Yeah. So if we jump over to the tech-heavy NASDAQ, kind of the same picture here. We could draw a similar regression trend channel. The numbers are going to be about the same, still in this upward sloping channel. But interesting that we're holding right at these big round numbers. Okay, so on Spider, I'll jump back there just real quick. You'll notice it's 510. That is the resistance area. And then here on the Qs, it's going to be 440 on the Qs. We really need to pop up above those 2 round numbers to see any continued follow through higher. Those big round numbers tend to be significant, pretty much significant resistance areas. So we'll keep an eye on that. But I don't see that much of a impedance right now, as long as earnings continue to be consistent. Now,
yeah, that's IWM, the same story there. Exactly.
The small caps, amazingly, with interest rates jumping, they continue to remain strong. In fact, we could put just a simple little trend line here on the bottoms of these ranges, and you can see the market just climbing right up there. The pressure is to the upside. Okay, there's really a lot of support down here, 195, 190, and the bias is towards moving higher. Okay, so same thing here, really getting above 200, which we are right now. 205 are our previous highs, as you can see here on this chart. I'll put my crosshair up there, 205. If we break above that, as the term goes, Katie bar the door higher, we could really run up on IWM, which would be an interesting feat in this market environment.
Crazy to see that happening. I mean, I honestly, with all these too, when you go over all these, I'm shocked that they're still going up this high. This is nuts to see this happening this far into the year, especially with everything happening. But earnings are good so far. The
Hey,
sentiment's
everything,
there. So
yeah,
yeah.
right. So we look at
Well,
other markets as well. Let's jump over to oil real quick. We use USO as our proxy for crude oil, and interestingly enough, it's up here at 72 half, which is pretty strong resistance, proving to be pretty strong resistance. I drew this horizontal line 2 weeks ago, last one we visited, and you can see we raced up and then just stalled right out at 72 half. Kind of the same thing here. Pressure is to the upside. How you would trade this, just so you know, is that really any vertical spread, maybe selling puts below or buying calls if implied volatility is reasonable. But USO is up 1.5% today, and like I said, that pressure is to the upside. If we get a couple of closing highs there, we could really run up to the 80, 82 half level, which is way up here at these previous pivot points. On charts like this, I do like to just take a glimpse at the Heikin Ashi, and this kind of clears things up for you. That it's not in a strong trend right now. In fact, we have a couple of red bars, but today's red bar is indecision. You have wicks on the top and bottom of the candle. So this area of resistance is proving to be pretty big. And it does kind of change my opinion a little bit that moving higher could be a little bit more of a chore than what we're expecting here on oil. But we'll keep an eye out, and there is definitely a trade in here to be had. So also like looking at the metals, Brandon. Gold and silver are still in play, but they're really not doing much. And what's interesting about gold to me, Brandon, is not only is gold, even though it's chopping sideways, okay, it's holding up here above this 185 level in spite of rising interest rates and a strong dollar. And those two things you often bring gold down, but that's not happening. Okay, so that's one of the interesting things about gold and the metals. Silver is kind of the same deal here. We're down almost 2% in silver today. And you can see the bias really is to the downside on silver. It's under a lot of pressure, but it's got a lot of support at $20 or about 20 half, meaning $20.50. That's where a lot of support is. But we'll just keep an eye on the metals to see how they're performing in this market environment. Gold is amazingly strong right now, even though it is choppy sideways, Brandon.
yeah, I'm shocked to see gold holding up this well with so many ETF outflows from the gold ETFs when it's trying to compete against Bitcoin right now. I think we've had in gold almost $4 billion of outflows of the gold ETFs, and that went right into the Bitcoin ETFs pretty much. A little
Well,
bit of a
remember,
shift in
I've talked about
what's
this
that?
before. I've talked about this before, where you have gold and silver. Now you have the cryptos, and the cryptos
Mhm.
will be considered alternative investments. And in the world of money management and asset allocation, um, you never put a majority of your assets as a money manager into alternative investments unless you're that type of fund. If you're just trying to beat the market and you're using typical asset allocation methodologies, you're only allocating about 5-10% of your portfolio to those alternative investments. So you're right. We're going to see some outflows moving from one to another. But remember, it's not a big, huge dollar amount of all the assets available because they are considered alternative investments.
I mean, it's, $6.4 billion have flowed into Bitcoin over the last month and a half. That's quite a bit, regardless, I think. And, I mean, gold is still the gorilla in the room with a $13 trillion market cap. Bitcoin's rising at $1 trillion now, just past $1 trillion. Catching up. But like you said, I agree. There's different asset classes, but we see the inverse correlation there. So it's interesting to see gold holding up as well it is. I do see a breakdown in gold here coming very soon, actually. So we'll see how that plays
Well,
out. And I think you think it's going to trade sideways there, right? Which I think
Well,
is kind of
I'm
good.
I'm all aboard.
188.
Pick a direction, up, down, or sideways. We can trade it.
Yeah.
So,
I know.
um,
That's the best part about your trading style, Jeff. I think you can trade anything any which way. It just doesn't matter as long as you can kind of like play this off whatever. So I think that's really cool about the way you trade. So that's
and granted,
awesome.
it's because we trade options that gives
Yep.
us the ability to do that. So yes,
Leverage.
absolutely.
Exactly.
Moving on to bonds,
Ah,
man, that's where the action is, believe it or not. Let's talk bonds a little bit. We're on the long end of the curve here on this chart, looking at TLT, which is the iShares 20-year Treasury bond ETF. That's considered the long end of the curve. And you can see that we're trading a little lower today, which means interest rates have jumped a little bit. And this 92 half level is an area of pretty significant support. We've talked about this before. All right. And it's still kind of embedded that this is, but if we break 92 half to the downside, this pattern that you see here is what really concerns me. This is known as a kind of a zigzag or ABC pattern. And if we move that out, you can see Fibonacci wise that we're calling for a move down to about $90 on TLT. That means interest rates on the long end of the curve, like 20 years and 30 years, rising. Now this takes time in the bond market typically, but higher for longer is definitely in play on TLT, and kind of the same thing on the short end of the curve. Now, what's interesting here is the downward trend on the short end, which SHY is the ETF that we're looking at here. This is the 1 to 3 year Treasury. This downward trend is a little bit more defined. We are once again at support here at about 81.5, a little above that. But this trend, it looks technically a little easier for this to drop. Now, if this drops faster than the long end goes, then the long end drops, that's going to widen the curve that we have, which is already inverted. And I've got that updated chart for you here in just a moment. But this, this pattern looks pretty ominous. I mean, we break down below this little support level, and Brandon, I'll draw my line in the sand here. We break below there, get confirmation, and look at the open spaces technically that we have below here before we get to a major pivot point. I mean, that could really ruffle some feathers in the bond market.
yeah, it looks like, I mean, just seeing your chart in that line in the sand, yeah, there's room to go down for sure once it passes that. What you talked about that yield spread, what's it looking like, you said?
Yeah, so the yield spread right now is at 120. If we take a look at that, interestingly enough, that compared to where we were the last time, we were at 117 on that inverted yield spread. Okay, and the real concern here is that we've been like this for well over 18 months, and especially if we get to the 2 year mark, which the 2 year mark would be coming up this summer, that could mentally be just a real problem for a lot of traders. So we're off those, we're widening once again, and that's just not good for the bond structure that we have, and just evident of some of the underlying problems that we have with, you name it, interest rates, U.S. debt, debt payments, bond auctions, etc. It's going to get worse for those.
Oh, jeez. You're so ominous. You're making everything sound crazy.
Well,
Mortgage rates.
it's not meant to be. It's not a scare tactic or anything. But when
Yeah.
you say, okay, market's going up, 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 great. We're making money, but you always have to ask yourself, what if I'm wrong? What if I'm wrong? How do I hedge myself? How do I protect? How do I, set up to maybe take advantage of that type of move without sacrificing too much gain to the upside? That's all it is, Brandon.
Okay, fair enough. I think that I like that. I like that strategy and that mindset. What do you see mortgage rates doing right now before we move on out of this section?
Well, I like tracking mortgage rates because it does affect a big part of our economy, which is housing. Last time we looked at this chart, we were just below 7%. We have crept up, and we're going to see this interest rates jumping around this 7% or more level. And how this affects housing is a lot of homeowners that were looking to sell may hold off and may not sell quite right now if they have a 3% or a 3.5% interest rate on their mortgage. They're just not willing right now to trade up to a 7.5. And I think that I think people should really look at this as more normal, because the only reason we had those low interest rates, 3% and lower, is because we had Fed Reserve interference. We had quantitative easing, a lot of Treasury buying. I mean, just a lot of pressure to keep interest rates lower to stimulate the economy, especially after COVID. And that's artificial stimulation. And now we're getting into kind of normalized rates. I think really you should look at it when we get over 10%. When we get to those double digits, that's when to kind of raise an eyebrow and really say, "Oh, okay." But as long as we're in these single digits, I think it's a good place to say, "Okay, I can still transact business. Housing prices are stable and growing. It's not as bad as it might feel."
Yeah, I mean, I tend to agree with you here. I think something to watch, and I'm glad that you bring this up every week because I like looking at those mortgage rates and how they're trending. That chart's perfect. With earnings last week, there was a lot of big earnings, but you mentioned we have 1,000 companies still this week. What's I mean, that's quite a bit. What's on your earnings outlook right now with those companies?
Well, if we bring up the sheet that I like to show, we have not only earnings, but we have, as I mentioned, starting tomorrow, we have a couple of economic announcements with durable goods. Fresh, fresh at 7:30, 8:30 a.m. Eastern time. Okay, we also have consumer confidence coming out later in the morning, and then we have core PCI later in the week and manufacturing PMI closing out the week. There's lots of economic data. On top of that, as you can see, these are just the most anticipated. Um, that can be because they're name brand companies. That could be because they're in a pretty hot space. All right, but there's just really too many to really focus on. Although we are going to focus on one here in a moment. But as you go through this list, there's a lot of retail. There's a lot of finance and insurance related. We are well represented here this week by different sectors of the market. So this will be a good week for to see where we stand across many industries as earnings keep blowing out. Over 1,000 names declared this week, Brandon.
That's crazy. And you talk about different sectors of the market, which actually segues us perfectly into your trade of the week. Let's talk about the sector everybody's talking about and the trade that you want to put on right now.
Well, we always like to kind of focus on a particular stock during earnings season. And today we're focusing on C3AI. The symbol here is AI. And interestingly enough, I wouldn't let today's candle fool us. Friday would have been a great day to enter this. As you see, there were 3 quiet days in a row. Today, we have a little bigger move. The stock is up. It's up 8%, but just by its name, C3.ai, with a stock symbol of AI, it's anticipated to be a mover. And interestingly enough, the strangle that we're looking at is priced for a certain percentage move of about 11-12%. Yet historically, the stock over the past several earnings cycles averages around 14-15%. That gives us our edge. And that's why we put these type of trades on. When we see this type of opportunity where pricing allows us to get in with a little bit of an edge, in a stock that can potentially break out, that's what we like to trade through earnings, Brandon.
I like that. With this trade here, when do you expect to get out of this bad boy?
Well, earnings on C3 AI are Wednesday after market close. So it would be before the week's out. Might stay in it for a day or two at most, but definitely exiting by Friday off the trade. And the light blue lines there are break evens, where you see the black line changing direction. Those are the two strikes. Okay, so you can do a 28 strike straddle, or you can do a 26, 27, or 28 type of strangle. But we chose the strangle just to reduce the cost a little bit, and the estimated moves are about the same. So we'd be out of it by Friday on this particular trade, Brandon.
I love that. Okay, that's perfect. That is a good quick trade, and I love those quick trades, and I love the way that you explain that and the way you put that on. Thank you so much for that. And we'll be hitting this next week when we get back together. Where can people learn more about these types of trades, Jeff? Where can they go to get some guidance on this?
Well, we trade straddles and strangles, which is a very common basic option strategy, but we do it a little different. All right. And you can find our guide on how we trade these two strategies through this link, which is ewotrader.com/straddle. And we can get that guide out to you right away. And it just is a little different way to look at the strategy and how we trade it. And hopefully it'll keep you out of trouble, because I think a lot of people, Brandon, do this strategy on stocks that just really they just historically just don't move. And when you have a stock like, that has the option symbol or the stock symbol of AI, I think it's a pretty good idea to maybe consider a trade on it.
Yeah, definitely. Go check out this book. It will help educate you on the way that Jeff trades. As always, Jeff, thank you so much for your analysis and for your overview of the markets. I think that's invaluable to us right now as we kind of go throughout these trading sessions and these seasons. Holy cow, last week, this week, everything's crazy. As always, nothing ever slows down in the market. If you have not subscribed to the channel already, please do so, and we will see you back next week to go over Jeff's trade to see how he did. We'll see you guys in the next one.